Big cap companies' earnings are always really expected, and we are about to start that earnings season this week. Specifically, the FAANG stocks earnings season, as we will see Netflix reporting earnings on January 20th, Apple on January 27th, Google on February 1st, and Facebook on February 2nd, and Amazon has not announced yet, but they are expected to be on February 1st as well, but we will have to wait for their confirmation. Hello everyone, Adriana here. So today I wanted to compare all of these stocks to see their valuations, their quarter 3 earnings, growth, and more, and at the end of the video compare all of them on an Excel sheet as I always do and see which ones I'm investing right now. Also, this is a comparison of their quarter 3 earnings as they will start reporting their quarter 4s this week, and I will also do an update video like this one after all of them report. The first stock in this list is Meta Platforms, or Facebook, ticker symbol FB, which is currently trading at $331.90 per share and has a market cap of $923 billion, whereas their PE ratio have been on a decline since 2015, 2016, and obviously it makes it more and more attractive as an investment. They have total daily active users of 1.92 billion, which is a 6% growth. I understand that does not sound that much of a growth year over year, and that means that the growth has been decelerating since 2019, as the growth was around 11% and now is around 6%. But to be honest, that is normal in my opinion. There are only 4.66 billion people with access to the internet, taking into consideration that China and Iran do not have access to Facebook, as it is completely banned in those countries. Still, they have 2.9 billion monthly active users. Geographically speaking, we can see that other than the rest of the world, the most growth was seen in Europe, yet US and Canada are the ones that with the higher ARPU, or average revenue per user. As always, what people or investors like the most from these tech giants are their gross margin and see their expense improving, with you can see that their expenses as a percentage revenue is in a constant decrease, and even though they have been growing massively, their cost of revenue has kind of stayed stable between 19 to 20%, which is impressive. We do have to take into consideration that even though Meta Platforms is often pilloried by regulators, privacy advocates, and other problems because of its business practices and market dominance, they have continued expanding and trying to innovate a lot even more by announcing their future plans around the metaverse. It is tempting to dismiss Facebook rebranding as Meta Platforms and its subsequent promotion to the metaverse as an attempt to divert attention away from the whistleblower scandal that erupted in September. But if we look at Zuckerberg's previous comments about VR and Oculus growth over the past year, it makes perfect sense to rebrand the company and shift its focus away from PCs and mobile devices, which obviously is a huge risk without a question, as they are basically rebranding their whole business, but one that we believe could be huge in the coming years. Second company is Apple, ticker symbol AAPL. It is currently trading at $173 per share with a market cap of $2.8 trillion, being the biggest company in the US with a PE ratio of 30.85. Historically speaking, we can see that it is really high at the moment. We all know that Apple has and continues to be a cash machine without any doubt. They reported a revenue of $83.6 billion in quarter 3, a 22.38% growth year over year, and a net income of $20.5 billion, a growth of 38% year over year. They have been seeing nice growth on their products, but also on their services. 51% growth for their products and 33% growth for their services. I do have to say that it obviously impresses me how Apple continues seeing such a nice growth, being so old and so big. I do believe that the stock might be a little bit high at the moment, and we will talk about that later on the video, but it has been my favorite company ever as an Apple user. I have tried almost all of their products and almost all their services, and I have to say that what they have created as a company is impressive. The ecosystem they have and the connectivity between their products, the designs, the chips, the softwares, hardware, and more. I do understand many don't like iPhones, but the brand recognition from Apple is the best one I have ever seen, which is what has made them grow that much and continue seeing this kind of growth. The next stock is Amazon, ticker symbol AMZN. It is currently trading at $3,242 per share with a market cap of $1.65 trillion and a PE ratio of 63.46, which we can see that it has been in a downturn as well. Amazon reported a net sales of $110.8 billion, which is a growth of 15% year over year. Obviously, not as much as the other two companies I just mentioned, but we do have to take into consideration the huge growth that Amazon had in 2020 due to the pandemic and reported a net income of $3.15 billion, which is actually down 50%. Now, Amazon has a gross margin of about 40 to 43%, which is incredible. And also, we can see that their net income went down as they have been investing a lot of money into their business to continue seeing growth and innovation and expansion. They are able to slow down those investments whenever they want and see more profit, but it is not their goal right now, apparently. This has been my biggest position in my portfolio since 2019, which is why I have a nice average price, but have been adding as well. And you guys know that I love this stock below $3,000, but would start adding below $3,200 or less. But we will talk about that later on the video when we compare all the FAANG companies. The next company is Netflix, which is trading at $525 per share with a market cap of $232 billion and a PE ratio of 47.40. Really nice historically speaking. Netflix reported a 16% growth on Q3, mainly driven by an increase in average paid streaming memberships, which, talking about that, they just announced their first price bump in North America since October 2020. Inflation. But this might be also because we have seen how subscribers growth in North America is slowing down a little bit, and this might be the best approach from them to continue seeing a nice growth, and that is something to have in mind for the Q4 earnings, which is going to be this week. Last company is Alphabet, ticker symbol GOOG or GOOGL. It's currently trading at $2,789 per share with a market cap of $1.85 trillion and a PE ratio of 26.81, which historically speaking has been maintaining and even declining as well, with a nice revenue growth of 41% year over year in Q3, and we know the potential this company has as well. I do have to say that I do not like their products such as the phones or the Chromebooks, but their main business, such as their ad business, is incredible and has a lot of potential, just like their cloud business as well, with both of their Google and their YouTube search engine. Now, let's compare the FAANG companies to see which one might be better investment right now. Now, we can see here that, for example, Facebook has we have a stock price here for each stock, but their stock change in the past year have been incredible, the comparison between them, because we can see that Facebook went up 29.90%, Apple 35.40%, Amazon only 3.9% in the past year, Netflix 5.6%, and Google a whopping 60.4%. So in this one, we can see that the one that has gone up the most has been Google, and the one with maybe the most potential is Amazon, as it stayed flat the whole 2021. But I'm not gonna give points to this, as we know that this can differ between companies. Now, their market cap in billions, we know that the biggest company is Apple with $2.8 trillion, then Google 1.8 trillion, Amazon 1.6 trillion, Facebook, and last but not least, Netflix. Now, their PE ratios. We know that companies like Amazon tend to have a high PE ratio, as it is expected for them to have a huge growth. But for this, I'm going to give the point to Facebook, as we can see that their PE ratio is the lowest one of 22.57. And we saw on their historically PE ratio graph how it has been declining while their fundamentals have been improving and their stock has been growing but not as fast. Now, their PEG ratio is another history. We can see that Facebook is at 0.91, Apple 3.8, 1.85, Amazon 2.05, Netflix 1.49, and Google 0.85, which generally speaking, a PEG ratio under 1 is considered undervalued. Therefore, we could see Meta and Alphabet benefit from a flight to quality next year if inflation and interest rates continue to rise. According to this, the best stock at the moment to invest according to this metric, the PEG ratio, is actually Google, as it is the lowest one, and then would be Facebook, then Netflix, Amazon, and last but not least, Apple. That is why I believe that Apple, in my opinion, is at a high price right now. At $170 per share is a little bit high. I would love to see it 110, 120, but maybe 130. I would not be adding to this position at this current prices because of that. It is really high in my opinion. I would prefer to add to Google and Facebook and even Amazon, because even though their PEG ratio is above 1, it's at 2.05, and actually Netflix has a better PEG ratio, I believe that Amazon will have a nice 2022, and in the long term, I believe that Amazon still has a lot of potential as well. All of them have a lot of potential, but for example, Apple has gone up a lot, and I would expect this company to either stay flat or if it grows up, go up a little bit, not as much as 30 to 40 or even 50%. Now, for the revenue, we can see that these are all of the revenue that have been having for the Q3. The company with the higher revenue is Amazon, then Apple, Google, Facebook, and last but not least, Netflix. But the revenue growth, the best one was from Google. As we can see that it grew 41%, and then Facebook with 35% year over year with an excellent growth, and Apple with a 29% growth. Now, I will wait for their whole year to see how each company did in the whole 2021, as remember that this is only for Q3. Now, their balance sheet is actually very, very nice for all of them. Obviously, one is better than the other ones, but all of them have a lot of cash and a lot of possibilities for the future of the company. First of all, we can see that the company with the most amount of cash is actually Google, and then we have Amazon, and then Apple, and so on. But the current assets, we have the total current assets here, total asset here for each company. I'm not gonna read each numbers. You can pause this video and read it if you're interested in that, but these are all the current liabilities and total liabilities. I have all this here because I like to calculate the current ratio and the total liability to total assets ratio. As you guys know, that a good current ratio for me is above 1 to 1.2. So everything above 1 is excellent in my opinion, meaning that all of these companies have a very nice balance sheet, with the best balance sheet, Facebook, of 4.23, meaning that they have way more current assets than current liabilities. As well as their total liabilities to total assets ratio, the winner is also Facebook with 21.36. But I do have to say that all of these companies have excellent balance sheet in my opinion, which gives them the possibility to continue investing and expanding throughout the years as a company, which is why I believe these companies still have a lot of potential in the long term, even though people believe that every decade the biggest companies or the best companies change and these companies will stay behind. But in my opinion, they still have a lot of potential. Now, because of this, we can see that the winner actually is Facebook with the lower PE ratio, with the best current ratio and total liabilities to asset ratio. I do have to say that the best revenue growth is Google and the best PEG ratio is Google as well. Now, I do have to say that, as I said, I am not investing in Apple at this current prices. I'm not investing in Netflix either. I'm investing in Facebook and in Google and also in Amazon on my Robinhood portfolio. But on my M1 Finance portfolio, I have a pie with all the FAANG stocks, so I actually invest in them monthly, as well as the funds such as the S&P 500 and all that I have in my portfolio. But right now, in my opinion, the best stock, as always, is Facebook, because of their valuation. It has always been, every time I do these videos, either Facebook or Google. So even though Google stock went up 60.4% in the past year, it continues having the best PEG ratio and the best revenue growth as well. So that is something to notice for the next quarter report. I do have to say that these companies are expected to go down a little bit of about 10 around 10 to 20% as they have been doing really nice this year. Not all of them, but we saw that Google, for example, has done well, Apple has done well, and more. So people and analysts are expecting this company to go down or at least stay flat this year while they are able to, while the fundamentals continue going up.